Despite the recent spate of volatility on the local and global stock markets, most institutional investors and financial advisors participating in the Investor Confidence Index survey no longer believe the local stock market is expensive. And joining us now to discuss the latest South African Investor Confidence Index for the month of August is Theo Vorster. He's chairman of the Institute of Behavioral Finance. Thanks so much, Theo, for joining us today. Well, there we have it. I've pretty much outlined what one of the standout features is, and that's that only 21% of institutional investors still regard the stock market to be expensive. Financial planners on that end, only 25% regarding the stock market to be expensive. So overall, things are looking pretty fair value, it seems.
Alishia, good afternoon. Yes, I think what has happened is with the market coming down and the strong historic earnings, the valuations has come into a range where participants don't believe the market to be expensive. In effect, the fact that only 21% of participants in terms of the institutional investors believe is expensive, if I put that into perspective, that same number was 73% in the first quarter of this year. So 73% of institutional investors in the first quarter of this year believe that the market was expensive. That's now only 21%. In effect, if you look at the overall number, 36%, more than a third of participants on the institutional investors actually believe the market is undervalued. It's offering value. So therefore, if you look at what the performance we've seen in the last 4 months, because remember, month on month, we've been down for 4 months in a row. And if you look at the strong earnings, there is a change in the valuation perspective of institutional investors. And to a lesser extent, we're seeing the same when we talk to financial planners. They also believe the market's not expensive anymore. It's not to the same magnitude, but yes, we are clearly seeing that where there was a perception in the first quarter of this year that the market is over expensive, it's too expensive to invest, that has turned around. In effect, there's only 21% of people actually now believe the market to be expensive.
Absolutely. And I mean, talking to traders at the desk as well, I mean, that seems to be overall the consensus at this stage when you're looking at the South African markets. But an interesting point was brought up this morning, saying that, you know, where we've got investors chasing this kind of value, there's the danger that they may be get caught up in a value trap where, you know, we're looking at valuations based on historics, as you say, and that potential for earnings to translate moving forward, not necessarily guaranteed.
Absolutely no guarantees. Remember, when a market is perceived to be inexpensive, that doesn't mean it can't go down further. It can get more and more inexpensive, or it can even get cheaper. So the one aspect is the fact that the market is slowly starting to offer value on a fundamental basis on historic numbers doesn't mean that this is the end of the volatility, number one. Number two, if you look at why the market is not expensive, we've had very strong earnings growth, and the strong earnings growth are continuing. We've had the market coming off, which means the relative valuations gap is closing. We're getting closer to, even in some cases, below fair value. But again, if you look forward, there is a clear lack of confidence in earnings going forward. So therefore, not only is it difficult to say if earnings is going to be maintained or growth, but there's a lack of confidence in making the prediction. So once you're in that uncertain environment, you will err on the conservative. That means you'll rather take a lower valuation than a higher valuation.
Having said that, that raises the whole issue of, you know, yes, we've seen valuations, or the valuation confidence index seeing a rise, but that's standing in stark contrast with the optimism, or with the pessimism rather, shown in the crash confidence index. Only 28% of institutional participants and 37% of financial planners believe that there's less than a 10% chance of the market crash occurring. So within that scenario, you know, to what extent does valuations translate into investors having the confidence to actually jump in?
Well, that's a judgmental call. I think the crash confidence index, and I must say I was slightly surprised in that number, but the crash confidence index is basically shows you the lack of let's say, clear visibility of earnings and the understanding of the underlying fundamentals. So, and it also points that this volatility can continue. The fact that we've been very volatile, the fact that we're getting cheaper and cheaper or less expensive, that doesn't mean the volatility is going to end. Remember, markets overreact on the downside and overreact on the upside. And there's a lot of emotion in current market movements. And if you just look at the daily media reporting and then the reporting even from portfolio managers, there's a lot of emotion and a lot of uncertainty. So the volatility will remain with us, even though we are showing more value.
Of course, as you say, sentiment-driven trade is what we're primarily looking at. In terms of overall expectations for the JSE, I mean, we've seen the JSE All-Share Index outperform emerging markets and developed markets. Those indices, you know, for this year so far. What's the outlook on this market managing to end in positive territory by the end of this year?
Look, if you look forward and you ask the participants of the survey to give us an idea of what they expect 3 months, 6 months, 9 months and 12 months forward, it's positive, but it's marginal positive. Nobody's expecting great earnings growth, but also nobody's expecting the market to be a lot higher than it is today. We're talking single digits, and we're talking probably in straight line 2, 4, 6, 8, 10%. It's in single digit numbers that we're looking forward. So I probably hope that from these levels onwards we will see, if you look at this, 2 or 3% real growth, nothing more than that.
Taking a look at, you mentioned earlier that we're looking at trade that is very emotion-based at this stage of the game. Is there a distinction to be made between financial planners and institutional investors and what they're actually looking at? Who's better able to sift out the noise and focus on fundamentals of actual companies?
Look, for the first time in a long time, for the first time in probably late 2009, middle 2009, we're seeing that the institutional investors are more positive than the financial planners. Up to now, we've always had the financial planners being the more positive ones right through the last 18 months. What we are seeing now is, for the first time, that has turned around. The institutional investor are more positive than the financial planner. That tells me that probably the financial planner is a bit more emotionally involved when we look at the last 2 months, because there has been a shift. I do think that shift has to do with the fact that there's more involved in terms of the emotion involved in terms of them and their clients, given the uncertainty that we're seeing. And perhaps at this time around, the institutional investor is a lot more prudent and perhaps a bit more rational when looking at the market, and perhaps appreciating that volatility will stay with us, but it is slowly starting to come back into buying territory.
Well, thanks so much, Theo, for your time this afternoon and for sharing some insight in terms of the frame of mind of investors out there. Of course, Theo Vorster is chairman of the Institute of Behavioral Finance.